Alright, so picking up where we left off, the last thing we talked about was valuation and market capitalization. So you've been watching, and in the last video we also said the only time you'll ever enter a position or ever make money on a trade is if you sell something way before everyone else wants to sell it, or if you buy something way before everyone else wants to buy it. So, and that all comes from valuating a company. The only thing that's ever going to happen is you're going to have some sort of volatility event. Put that in big box. This is the total driver of every trade. You've had some volatility event. You think the company is either now way overvalued or way undervalued, and you want to enter a position. How do you do so? The thing you do is you develop a trade prospectus. These are things that I think you should have every single time before you enter any trade. Max risk, ideal entry, profit target, and expected trade duration. Max risk is pretty obvious, literally what you are willing to lose. A lot of traders will say maybe 1%, maybe 10%, I don't know. This really comes from why you are in the market. If you have maybe $100, $1,000, you want to try to make it go up real fast, you're probably going to be risking all of it. If you're managing your 401k or your retirement fund, max risk is probably a lot lower. But this is really what defines what type of trade you take, because the amount of opportunity that's present in the market is just tremendous. On top of that, you want your ideal entry. What price do you think is any trade? You obviously want to make the most money. To do so, you have to time the trade optimally. And now people will say you can't time the market. You can't, but you absolutely should try. And so that's why you have an ideal entry. Then you have your profit target. This is just the level you think the stock or financial product's going to get to and how long you expect to hold that. And these things give you just an overall, you have the total trade mentality, or the trade laid out before you enter it. So we'll talk about the psychological biases, but this, you should really do this every single time before you trade anything. And now how do you do these things? How do you calculate an ideal entry? And this is where you get into technical analysis. This is all of the charts you've ever seen if you open up any trading software. I have printed out, just to give you just a simple example. This is just the price chart of Facebook, and this is today, which is, I think that's not the first, it's July 3rd. So that's what a chart looks like with technical analysis. Those are your bar charts. I guess I'll go over that now. So if you're looking at a green candle, the bottom of the candle is where the price opens at. If you go up like this, boom, you have this little wick up here. This top wick, the top of the candle is where it closes at. And this is a green candle. This is an appreciation day. This wick up here is where the price hit intraday during that trading session. I'll just put, this is green. On a red candle, same thing but the opposite. The top line is where the price that you opened at, and the bottom one is the one you closed at. And again, you can have wicks up and down, and this is technical analysis is what you're going to use to enter a trade. And those are what those, I can't really see behind the camera. Okay, I get way closer. It doesn't really look that good. But well, you can find these yourself. These are everywhere. But the thing that I really take to heart on technical analysis is every single indicator, there are hundreds if not thousands of them, there are tons of different strategies. Every single one of them is a trailing indicator. They all indicate something in the past. They do not indicate what's going to happen tomorrow. And again, my trading strategy, and truly anyone that makes money, you're really I can't say that, but you want to have a fundamental stimulus more so. Technical analysis tells you when you want to enter a trade, fundamentals tell you why. And so the only technical indicators that I really use are, I wrote moving averages up here, EMA, which is exponential moving average, versus the simple moving average, which is SMA. Simple moving average is just you can enter parameters if you're going over, like if you have Okay, so on your bar charts, you have a bunch of different time intervals you can do. This one right here is I think this is a 10-day, 30-minute chart. And you can enter any amount of days, time frame you want. But the exponential moving average or the simple moving average, with whatever the parameters you have set, if it's a simple moving average, you are just assigning the same weight to all of the previous days. How much has that stock price moved in the past 9 days, 12 days, 15 days, 150 days, whatever. Exponential moving average weights the more recent days more relevantly. And these are, I use EMA, I use one EMA, I use it on a 9-day. And that's just because people remember the past more poignantly than the further past. So this makes sense to me. And even past that, really the only technical indicator that I like is the volume weighted average price, which is called the VWAP. And the reason I like that is because, again, it's simple supply and demand. If you have a well-financed client and you're a stockbroker and they want to enter a bunch of shares of Facebook, they're going to have to do so over hours, days, or even weeks. And to do that, the broker's obviously going to want to pay the smallest price they can get if they're going long. So the client's going to be more happy. So the volume weighted average price tells you what the average price per share people have paid in that time frame. And this gives you your intraday or intra-week or whatever your time frame is. This gives you that metric. And I really like this because I said this is supply and demand. This is really when you see the intraday extensions of a trend. And now, so you have your trade prospectus. You say this is what I think is going to happen. This is what I want's going to happen. You have, and I will, if people, like I said, I use technical analysis. The way you get good at technical analysis is just watching the stock market for a lot of time. Whatever metrics you pick to use the same ones over and over and over and over again. The exponential moving average that I use, the chart, I go for intraday trades. I would say this is specific to intraday trades. I use a 5-day, 3-minute chart, and my exponential moving average this is my setup, but I guess so the weight comes again on the 3 minutes. Again, this is not the setup that I just talked about. This is just an example of a chart. But now, okay, so you have some trend that you expect to be either way extended or you have a trend extended either to the up or to the downside. How do you get into a trade? Well, you have to place an order. Where's that piece of paper again? And so to do so, there are two to open. I don't know if there's just two, but for the beginners, I would say, these are the only types of orders that I run into. To open is either a market order or a limit order. A market order is when you see the prices for a stock, you'll see a bid and an ask, or again, any financial good product. The bid is what someone's willing to pay for that product right now, and the ask is what someone's willing to sell for it. The difference is what's called the spread. The tighter the spread, if you have something selling for $1.01 on the bid, and then on the ask, $1.02, that's a tight spread. There's a one penny differential. If you're just getting into trading, the tighter the spread, the better. If you like to get frisky in the markets, you can play around with that quite a bit. But a market order, what a market order will do is it will execute, if you're buying a security, it will execute at the ask price. If you're selling something, it will sell at the bid price. And the reason you would do that is because if the stock or whatever you're looking at is moving really quickly and you just want to get into the position, you'll probably execute a market order. Now, the next one is a limit order. And I think these are way better. I personally trade high momentum things all of the time and I still use limit orders. I would say 80% of my trades. So a limit order, to the contrary, is you put a bid on the bid. You don't execute on the ask. You say, if someone's willing to pay $1.01, I am also willing to pay $1.01. And then that order won't fill immediately. It will fill if someone decides, if that in the next 3 seconds, 5 minutes, 5 hours, whatever, if someone hits sell at that price, that's when you will fill your position. And I put order types, I put stop loss and trailing stop, and the next thing we're going to do is talk about managing position. But these are these are the orders you would use to close out your position. So let's talk about that now. All right, so you've entered the position now. Now what do? You've entered the position. Now what? Well, you're basically going to start going up or down literally immediately. So I have here written, rising like the phoenix or FUD, fear, uncertainty, and doubt. Think about it. You just buy a stock. It goes up 5% in, I don't know, 2 minutes. Dude, are you serious? Foreign whips, Hermes bag, Birkin bag, Cartier frames. You're feeling sweet. Now it goes up 50%. Dude, boats, cars, cribs, all of that. 5 seconds later, it turns maybe 3 seconds. Boom, you're slapped with FUD. Oh no, dude, just losing all the money I just made. What do I do? What do I do? What do I do? Managing a trade is literally the most important part of all of this. If you enter any position and you know what to do, you can probably make it go profitable at some point. If you're in a profitable trade, how you become extremely profitable is by retaining those profits and building portfolio value over a longer period of time. And so, while you probably think I'm joking around and I am having fun with it, you will really feel like that. And many people will tell you to paper trade before you real trade. I fundamentally disagree. I think you absolutely need to trade real money to feel these things. Because once you just, again, if you know exactly what you can risk, the only way to get used to those types of feelings is just to do them a lot. So now to actually be more, and to see this in action. To see this in action. Again, today is July 3rd, it's like 3:15. Bitcoin's not doing too crazy movement right now, but the rising like the phoenix or the FUD mentality has never been stronger than what I've seen with Bitcoin. I'll be doing a whole video of Bitcoin, maybe in this one, probably not this video, but definitely it'll be coming out here soon. But what I want you to do is go on StockTwits or any stock forum, but StockTwits is a very popular one, and just read through postings when Bitcoin's price is going crazy. And you will literally see these types of things just going all haywire. And that's why you have a trade prospectus. Now granted, once you develop all those things, the minute you enter a trade, you're going to start feeling these emotions, and at the beginning, my guess is you're going to have a more difficult time managing the trade. But to what I said as you can, I don't say if you for sure, but if you know how to manage a trade, your entry point, the initial entry point is not as important if you're averaging in. I don't say you should never take your whole position size at the beginning, but I would recommend if you're going to invest $1,000 in something, and you say my risk is $1,000. You shouldn't put $1,000 up on the bid or on the ask immediately. Maybe you do $500. What I typically personally do, again, I do different strategies depending on the trade, but for an intraday day equity trade, I would do I'd probably enter with 500 to 1,000 shares, and then once boom, I've hit that, then I'll do another 500 to 1,000 shares. And that's to get my base risk of 1,000. And again, like I'd have to give you price per shares and an actual security to show you that example. But we'll be doing examples. But my point is, you will feel those emotions, and you still need to manage the trade properly. So what do? When should I add to a position, or when should I close a position? And then we touched on the how on the last video. But for me, and the thing that makes a lot of logical sense to me is anytime you have a winning trade, you should add literally as much as you can while maintaining that the risk tolerance. And so what does that look like in practice? Again, I enter a position for, let's say, 500 shares. It starts going into my favor. maybe, again, it can start going in my favor in literally seconds or literally hours, minutes, or days. We'll stick to intraday here. So let's say that I enter a position long, it starts going in my favor over the next 2 minutes. Maybe I add another 500 to 1,000 shares. Whatever your total share size is, I would recommend 2 to 5 entry points, and I personally close my positions all at once, with the caveat, if I'm investing in a microcap stock, something that's less than a penny, or really any time that I'm in anything that appreciates more than 100%, I'll sell half of it and build my portfolio value by keeping the other half shares literally indefinitely with no plan to sell them. But so if you have a winning trade, you should add as much as you can. And this will be very obvious when we do real examples. Okay, so now the opposite, the closing position. You get into the trade, and now you start losing, and you have this FUD going on. Oh, what do I do? What do I do? Again, if you have your trade prospectus done and you have your stop loss, you already know this. This doesn't really play into your mentality at all. But to actually execute an order, stop loss, this is when you're in a losing trade. This is literally just a limit order or a market order at whatever price you want to get out of the trade at. A trailing stop is to preserve profits. Granted, you can do market or limit orders to close a profitable trade, obviously, as well. But my go-to for a profitable trade is a trailing stop. And what that literally does is, let's say you're in a stock and it's again at $1.01. Sometime later it goes up to $1.50. You're up 49 cents a share. You don't want to lose your money, but you still want to stay in the trade to maybe make more money. You would use a trailing stop. And what that does is you set some predefined, let's say you set your differential at 15 cents. Your stop loss, I guess stop loss doesn't necessarily have to be for a losing trade, but it will ratchet up as the price changes. And now let's say it goes from $1.01 to 1.50, and then some short time later it snaps down to $1.15, and your trailing stop was 15 cents. You would have stopped out at $1.35. Yeah, and that's managing position. And now, to bring all these ideas together, again, it's painfully apparent once you use examples. So now we go over my actual trades, and once I'm done with those, I haven't been trading super much or that frequently recently. I've just been waiting for something to develop in the market that I like. But I really hope to get a good, or several, like I said, I'll post my losing trades as well, but a good just series of active trading, live trades, not even old trades. So let's do that.